Today, we're talking about Bitcoin. You know the feeling. It seems like the entire crypto market is living in its shadow. When Bitcoin goes up, everything goes up. When it falls, the whole market just bleeds red. Well, we're looking at a 2023 research paper that might have finally uncovered the real reason why, and it's all in our heads.
I mean, it's the question every single person in crypto has asked themselves. How can it be that when Bitcoin's price soars, all these other altcoins with completely different projects and technologies just magically follow along? And when it tumbles, it feels like it drags the whole market down with it. Is there some kind of hidden market mechanic at play? Or is it something else entirely?
Well, according to this 2023 study, the answer is way deeper than that. It's not about algorithms, it's not about asset classes, it's about something way more primal. It's about raw human emotion. The researchers found this powerful psychological current that's basically pulling the strings of the entire market.
All right, so here's how we're going to tackle this. First, we'll look at Bitcoin's massive ripple effect. Then, we'll get into the key psychological drivers that are really at play here. After that, we'll see how the researchers split up the market into bull and bear periods, which is super clever. And then, the main event. We'll reveal the study's key findings and, most importantly, what this all means for you.
So, the researchers behind this paper set out to measure exactly how much of Bitcoin's risk, its volatility, spills over into 10 other major cryptocurrencies. We're talking everything from giants like Ethereum all the way to meme coins like Dogecoin.
So, they started with this idea that we all kind of feel is true, right? That Bitcoin is the market's puppet master. But they wanted to dig deeper. They asked, does the type of investor matter? Does a seasoned pro react differently than a casual trader who just jumped in? That was the real question.
Now, to really get what this study uncovered, we first need to get on the same page. We need to learn the language they used. So let's quickly define 3 key concepts that are absolutely crucial for understanding how we as humans behave when our money is on the line.
First up is volatility spillover. Now, this sounds super technical, but it's just a fancy term for that ripple effect we've been talking about. It's basically asking, when Bitcoin gets all choppy and unpredictable, does that risk spread like a financial cold to other coins?
Next is a feeling I think we all know, maybe a little too well. FOMO, the fear of missing out. In the world of trading, this is that gut-wrenching anxiety you get when you see a coin rocketing to the moon and you're not on board. It often leads to that frantic, impulsive buy right at the top.
And finally, we've got the dark side, pump and dump schemes. This is just straight-up market manipulation. Scammers use hype, they use lies, whatever they can, to artificially inflate a coin's price. They pump it up, luring in all those FOMO-driven buyers. And once the price is high enough, they sell everything, the dump, and the price crashes, leaving everyone else holding the bag.
Okay, so with these psychological tools in hand, the researchers did something really smart. To see if the overall market mood changes how people behave, they split all of their data into 2 simple buckets, based on one single thing: how Bitcoin did on any given day.
It was pretty straightforward. They called it a bull market day if Bitcoin's return was positive, and a bear market day if its return was negative. And this really simple but powerful split let them see if altcoins react differently to Bitcoin's good days versus its bad ones.
All right, let's get to the good stuff, the findings. After all this setup, what did the data actually show was happening under the surface of the market?
So when they first looked at how Bitcoin's volatility spilled over to other coins, the results were, well, they were kind of messy actually. For big players like Ethereum, the spillover was way stronger during bull markets, when Bitcoin was up. And the researchers think this points to uninformed traders just jumping on the hype train, classic FOMO. But for other coins like Ripple, the spillover was actually stronger in bear markets, which might suggest that more rational, informed investors were making strategic moves when things were down.
But here is where the researchers had their big breakthrough moment. They completely shifted their focus. They stopped looking at how Bitcoin influenced other coins and started asking a much more powerful question. How do these altcoins react to their own price movements? And let me tell you, this is where the picture became crystal clear.
And the answer, the smoking gun, is right here in the study's own words. When they looked at the coins individually, they found, and I quote, overwhelming, undeniable evidence of FOMO and pump and dump schemes driving the market.
So how did they know? Well, it was actually simple, but pretty profound. For almost every single coin they looked at, a sudden price increase caused way more volatility and market chaos than a sudden price drop.
Think about that. That pattern is the classic fingerprint of inexperienced traders chasing hype, piling in, and falling for pump and dump schemes. The only coin that didn't show this pattern? You guessed it, Tether, the stablecoin, which is literally designed not to be volatile.
And this chart here shows another fascinating twist. The COVID-19 pandemic basically threw gasoline on the fire. The study found that after the pandemic hit, Bitcoin's risk spillover to several altcoins, like Dogecoin, just shot through the roof. It suggests that this global crisis pushed even more emotion-driven, frantic behavior into the market.
So, okay, after all this deep academic analysis, what's the bottom line? What's the practical takeaway for anybody just trying to navigate this absolutely wild world of crypto?
Well, the study's authors leave us with some really clear, simple advice. They say the #1 most important thing is to recognize that these powerful psychological forces are at work, both in other people and in yourself. And you have to actively guard against them. That means you've got to resist the FOMO, you've got to diversify your portfolio, stick to reputable exchanges, and stay informed about a lot more than just the price today.
And all of this leaves us with one final, big question to think about. This research basically proves that in crypto, understanding the psychology of the crowd is every bit as important as understanding the technology of the asset. So the real question you have to ask yourself is, which one are you trading?